Good morning, dear students. I welcome you all to this revisionary session on CA Final, AFM, Advanced Financial Management. And today we are going to revise two topics through a series of case scenarios. One is going to be the mutual fund and another is going to be the security valuation. Now, this motive of this session is to get yourself acquainted with, the type of case scenarios we may come across, and also an effective way to recap all the concepts in one go. Okay, so we will try to recap the concept with the help of certain case scenarios, and in case you are having any sort of queries, we will definitely entertain the same. Okay, so now let us just get started with the case scenarios. We'll try to do the concepts along with those case scenarios. Okay, so we have in total 1, 2, 3, 4 in 5 case scenarios. Yeah, so there are 5 case scenarios that we are going to discuss in today's session. Okay, so let's just go ahead with the first case scenario, guys. So the data given below relates to a convertible bond. So this data is belonging to a convertible bond. The face value is 450. Coupon rate is 15%. Number of shares per bond is 25. And market price of share is rupees 20. Straight value of the bond is rupees 400. Market price of convertible bond is 5. These are certain set of information data given to us, and we have to answer the questions one by one. Okay. So now before we go ahead with this case scenario, we need to understand certain concepts over here. Let's look at the questions that are asked to us, and then we'll think about what is, what are the things that we're supposed to answer. So the first thing that we have been asked over here is, what's the stock value of the bond? Percentage of downside risk based on market price of convertible, conversion premium, conversion parity, price. Okay. So these are certain concepts that we need to first revise, and then we'll try to answer this. Okay. So let's just look at these case scenarios. Let me just change the screen for discussion. Yeah, now it is possible. Now it is visible. Okay, so first up, when we look at the convertible bond, so in talking of convertible bond, this is essentially a bond in which there are two characteristics. One is it's a debt instrument. Okay, it's a debt instrument plus equity characteristic, right? So it's a convertible, so it's a hybrid instrument sort of thing, wherein the bond is going to be converted on a future date, right? So debt instrument plus equity characteristics. Now, these convertible bonds, which are essentially debt instrument plus they are having certain equity characteristics. We know that the convertible bonds can be converted into equity shares on a future date, and the number of equity shares which they can be converted into is also fixed, right? So there are two things that we are going to observe over here. One is the market price. Market price of the bond, which is also you're going to call it as the value of bond. So market price of bond, or this is also what we are going to call as the value of bond. Okay. Now remember, when we are talking of this convertible bond, what do you expect the market value of the bond to be equal to? It is going to be, since it's a hybrid instrument, yes, since it's a hybrid instrument, the value of the bond is going to be an effect of both. That is a straight bond, that's a non-convertible bond, and some sort of call premium. Right? So market price of bond is going to be straight value of the bond okay. So it's going to be straight value of bond. Now, when I say straight value of the bond, it is simply the bond. It is simply the value of the bond without any conversion, right? Bond value without conversion. Straight value of bond is bond value without conversion characteristic. Or you can say, I'll simply say it like this. Straight value of bond is non-convertible bond value. Okay. And to that, you add a call premium. Now, this call premium is essentially the extra money or extra value which the investors are assigning to the bond because of that feature, because of the feature of the conversion, right? So, the value of the bond that you observe in the market is going to be a cumulative effect of straight value of a bond plus call premium, because since this is a convertible bond, you can actually call the bond. I mean, as an investor, when you're holding this bond, you have a choice, you have an option to get it converted to equity shares. You have an option or a choice to get it converted to equity share, and therefore you have this call premium over here. Okay. There is one more thing called as a conversion value of the bond. Conversion value of bond. Now, conversion value of bond is total value of shares that will be received. Right? So conversion value of the bond is basically total value of the shares that will be received today if converted. Total value of shares that will be received today if converted. So today, if you are going to convert this particular bond, then what is the value that you're going to receive? That's what we simply mean by the value of the bond. I mean the conversion value of the bond. Okay. Again, there's some issue with some second. Yeah. So conversion value is the total value of the shares that will be received today if it is getting converted. Now remember that since it's a convertible bond, the value is going to be definitely higher than a straight value of a bond, right? And now conversion value is the total value of the shares that you're going to receive today, right? If it is getting converted. Now always remember that the value of the bond, value of the convertible bond is going to be not falling below a particular level, but it always have the highest potential. Value of convertible bond is going to be you know, in between certain values. The value of convertible bond is definitely going to be more than straight value of the bond. Right? So value of convertible bond is going to be more than the straight value of the bond. And it is definitely going to be lesser than value of convertible bond is going to be higher than the straight value of the bond. And it is going to be, bound by, the straight value of the bond plus call premium. Straight value of the bond plus the call premium. Okay. Now, this value of the convertible bond, needs to be functioning between these two values. And there are certain other aspects also that we need to answer. Okay. So let's simply go ahead with the first MCQ. Now, the stock value of the bond. What do you mean by stock value of the bond? As I said, stock value of the bond is, which is called as the conversion value of the bond. So stock value of the bond is simply going to be, the stock value of the bond is going to be the value that you're going to receive on conversion. The value that you're going to receive on conversion. So can you tell me what will be the value that we are going to receive on conversion? What is the value of shares that we are going to receive on conversion? Yep. If I convert this bond into shares, what is the value that I'm going to receive? Can I say it's simply going to be, we are going to receive 25 shares and each of the market price is 20. So this is going to be 25 into 20, which is 500. So the correct option is A. Stock value of the bond will be 500. Simple. Now, percentage downside risk. Percentage downside risk. As I said you that the bond value is going to be in between the straight value of the bond and straight value of the bond plus the call premium. So value of the bond cannot be falling below the straight value of the bond because since it's a convertible bond, you are still going to realize, right? Since it is a convertible bond, you're still going to realize the straight value as such. So percentage downside risk based on market price of convertible bond is, first I need to get the straight value of the bond, which is already given to us, 400. Market price of the bond is 550, right? So by how much can this bond value really fall? Because even if the market price of the share, even if this 20 becomes 0, still you will have this straight value of bond working for you. Still you will have the straight value of the bond. So even if the market price of the bond is, if the market price of the shares falls to 0, still the bond is going to have certain value, right? Even if the market price of the share is 0, it falls to 0. Still, the bond is going to have the value or it's going to have a characteristic similar to that of a straight bond or non-convertible bond. So what's the percentage downside risk? It can fall by what percentage? It can actually fall from 550 to 400. It can fall from 550 to 400 upon, so it's 550 minus 400, so upon 550. So this is going to be what? 550 minus 400 upon 550. So what's the percentage downside risk, guys? So that's 550 minus 400 divided by 550. That's 27.27%. So this is your downside. So bond value is not going to fall below 400. So downside risk is you're having 27.27%. Then the conversion premium. So for conversion premium, I need to get the conversion value or the stock value. Conversion value or the stock value. Conversion premium is simply going to be the conversion value or the stock value. So conversion value is going to be, conversion stock value is what we already computed, 25 into 20, which is 500. Okay, 25 into 20, which is going to be 500. So conversion premium is, see, if I'm going to get the shares converted today, it's going to give me shares worth 500. In the market, the value of the bond is still 550. So the value of the bond is going to be 550, which means as compared to the current ongoing prices of the shares, the conversion value is lower. People are paying the investors in market are paying additional 50 rupees to acquire this bond. So the conversion premium that we have is 550 minus 500 divided by 500. Right, so 50 divided by 50 divided by 500, which is going to be 10%. So option A. So conversion premium that we are paying is 10% of the conversion value. Now, conversion parity price of the stock. So conversion parity price of the stock is simply look at the current market price. The current market price is 550. Against this current market price of 550, how many shares are you going to get? How many shares are we going to get? Number of shares per bond is 25. 550 divided by 25. 550 divided by 25. Right. So what's going to be the conversion parity price, guys? We are going to get how many shares? Yeah, 25 shares. So conversion parity price of the stock. So stock, basically, we want to know what should be the price of the stock so that the shares that will be received is equal to the current value of the shares, current value of the bond. So 550 divided by 25. 550 divided by 25, which is 22. Okay, so that's C, which is 22. Okay, so that's your first case scenario. I hope we are clear with this. Everyone? Are we good with this? Yeah. Okay. So let's go for the next case then. This is a case on mutual fund. Mr. Y has invested in 3 mutual funds: mutual fund X, mutual fund Y, and mutual fund Z. So amount of investment is 4 lakh, 8 lakh, and 4 lakh. Net asset value at the time of purchase was 10.3, 10.1, and 10. Dividend received up to 31st March 2023 is 9,000, 0, and 6,000. NAV as on 31st March 2023 is given as 10.35, 10, and 10.3. So there are the details about the 3 mutual funds. Effective yield per annum as on 31st March 2023 is 9.66%, minus 11.66%, and 24.15%. So just assume that 1 year is equal to 365 days. And from the information given above, choose the correct answer to the following questions. Okay. So first up, total NAV of mutual fund Y as on 31st March 2023 would be approximately right? Total NAV of the mutual fund Y as on 31st March 2023 would be approximately equal. Now, this is our mutual fund Y. We have the net asset value as 10.10, right? 10.10 NAV of the mutual fund Y as on 31st March 2023 would be approximately. So 10.1 is the NAV at the time of purchase. Now, NAV as on 31st March 2023, opening NAV is 10. Amount of investment is 8 lakh. Now, when you have made an investment of 8 lakh, at that time the NAV was 10 per unit. No, that time at the time of purchase, the NAV was 10.1, and now as on 31st March 2023, the NAV is 10. So you want to know what is the total NAV as on 31st March 2023, guys. So what will be the total NAV? Okay, so total NAV is simply going to be 8 lakh divided by 10.1, because this is the number of units which you have got, right? So amount of investment was 8 lakh divided by 10.1 multiplied by the current NAV, which is 10. So this is going to give us an answer of 8 lakh divided by 10.1 into 10, which is 7,92,079. So answer is option C, right? Then second question. Total yield of mutual fund X in terms of rupee would be approximately. Total yield of mutual fund X in terms of rupee would be approximately. Now, when we talk of yield, mutual fund X, we have made an investment of 4 lakh, right? And this amount of investment of 4 lakh was made at the time when the NAV was 10.3. We've also received a dividend. And the closing NAV is 10.35. So what's the total yield in terms of INR? So we have 4 lakh is the investment. 4 lakh is the amount of investment that we have made. And we have made the investment at a price or at an NAV of 10.3. So we would have received how many units, guys? 4 lakh divided by 10.3. We would have received 38,834. 38,834.95 units. 38,834.95 units. This is the number of units that we have received. 4 lakh divided by 10.3, 38,834.95 units. This is the amount of units that we would have received. And on this 38,834.95 units, we have to multiply. We want to know what is the yield that we have made. So on this 38,835.95 units, what's the capital gain that we have made? So we have made a capital gain on this, 38,834.95. Capital gain is 10.35 minus 10.3. Right? So the amount of capital gain that we have here is that's going to be 38,834, or rather it's 10.35 minus 10.3 into 38,834.95. 1941.75. This is the amount of capital gain that we have. And on this, we also have a dividend. We also have a dividend. So dividend is going to be 9,000. So add to it 9,000. The total, yield in terms of INR would be 10,941.75, which is option A, guys. Correct. Then question number 3. The number of days for which mutual fund is held would be approximately equal to. Now we want to know the number of days for which a mutual fund X was held. Because effective yield per annum for mutual fund X is 9.66. We want to know what is the number of days for which it was held. So we already know that it's 10,941 is the INR value that we have. Okay, so that's like 10,941.75. 10,941.75 divided by 10,941.7 divided by 4 lakh, right? So this is the amount of yield that you have, 10,941.75 divided by 4 lakh into 365 upon number of days into 100. That's going to be equal to 9.66%, yes. So now we want to know the number of days. So how do we get the number of days, guys? How do we get the number of days? Yep. Can you calculate the number of days and give me? Give me the number of days, guys. Calculate the number of days and tell me the answer. Are you able to get the number of days? Yeah. So it should be 1 upon days will be equal to 9.66 into 4 lakh divided by 10,941.75 into 365 into 100. So we can definitely say that number of days is equal to 10,941.75 into 365 into 100, right? And is going to be like what? 39,93,73,875 divided by 9.66 into 4 lakhs, which is 38,64,000. 39,93,73,875 divided by 38,64,000, which is 103. 103 days. Yes. Yeah. Option C. Then number of days for which mutual fund is held. Number of days for which mutual fund Y is held. Just try to calculate this, guys. Fourth one. Number of days for which mutual fund Y was held. Can we do it? Everyone? Yeah. Try to solve this. Question 4. It is similar to a combined effect of second and third question, guys. Are you able to do it? Yep. Number of days for which mutual fund Y is held. So first, we need to get uh, the yield that we are having on a mutual fund, right? And then we can take up the other part, take up the number of days calculation. So remember, mutual fund X is done. So mutual fund Y, we would like to know the number of days over there. So for that, mutual fund Y, the investment was 8 lakh. And when the 8 lakh investment was made, it was made when the NAV was 10.10. And the NAV as of closing is 10. And still they're saying that they made a loss of 11.66%. So first up, we know the number of, the total NAV as on 31st March 2023 is 7,92,079. This is what we have already computed. Right, 7,92,079. This is what is already computed. That's the NAV as on closing NAV. So over here, if you talk of what is the capital gain over here, capital gain is 7,92,000 and 029, 079, 7,92,079 minus, this is the closing NAV, minus the opening NAV is going to be 7,92,079 minus your amount of investment is 8 lakh minus 8 lakh. Right, so we have made a capital gain, which is a negative number, 7,92,079 minus 8 lakh. That's 7,921, negative 7,921. Is there any dividend received over here? No dividend received, sir. So of course, the yield that we have is 11.66. We would have got this 11.66 as minus 7,921 upon an investment of 8 lakh into 100 into 365 by number of days. And that is supposed to be equal to minus 11.66. So can you just solve this and get the value of D, guys? Can you solve this and get the value of D? Yep. What's the number of days that we're getting? So the number of days we're getting is, this is 1 upon D is equal to minus 11.66 into 8 lakh divided by minus 7921 into 100 into 365. So how much is this? 11.66 into 8 lakh divided by 7921 divided by 100 divided by 365. 1 second, there is some issue. 11.66 into 8 lakh divided by minus 1 second, there is some problem, I suppose. 7 lakh 7921 upon 8 lakh into 100 to 365 by D is minus 11. So this is going to be minus 11.66 multiplied by 8 lakh divided by these numbers. 11.66 into 8 lakh, 9328, 7921. Further divided by, no, there seems to be some problem. Since it's having a annual yield of 11.66, once again, 7921 divided by 8 lakh. So this is 0.009901 into 100 into 365 plus 361.39. Three 61.39 divided by 11.66. Yes, 31 days. Yeah. So you're getting this as D is equal to 31 days. So it is option A, which is 31 days. Okay. So that's with this mutual fund case scenario. So this was case scenario number 2. Let's take up the next case scenario number 3 now. Again, this is a case from security valuation. Okay, let's read this case scenario first, guys. Just give you a minute's time. Just go through this case scenario, then we'll start with the discussion. Okay, so XYZ Limited needs funds for a short tenure. Some functional level managers suggested about the bank credit or overdraft option. On confirming from finance department, it was found that company exhausted its credit limits due to meeting recent contingency fund requirement. Then CAX CFO suggested the idea of floating commercial papers by XYZ Limited. Accordingly, XYZ Limited is planning to issue commercial paper, the details of which is given below. So issue price of commercial paper is 97,550. Face value is 1 lakh. Maturity value is 3 months. Issue expenses are brokerage 0.15% for 3 months. Rating charges is 0.5%. Stamp duty is 0.175% for 3 months. From the information given below, choose the correct answer to the following questions. The bond equivalent yield for an investor of the same commercial paper shall be approximately. So the bond equivalent yield for an investor of the same commercial paper shall be approximately equal to. So bond equivalent yield is something you want to compute in annual terms, definitely. So we have this commercial paper which have been issued. Okay, so commercial paper, equivalent yield for an investor of the commercial paper. Now, issue price is 97,550 and it's going to mature to 1 lakh. Right, so this is going to be 1 lakh minus 97,550. This is what we are earning. Right, so on an yield of 97,550. So 1 lakh minus 97,550 upon 97,550 into 12 by 3 into 100. So 1 lakh minus 97,550 divided by 97,550 into 12 by 3 into 100. So it's like 1 lakh minus 97,550 divided by 97,550 into 12 divided by 3. Then you make it equal to 100 into 100. So that's 10.05%. So option B over there. Then effective interest rate per annum on the same CP shall be approximately. Effective interest rate. So effective means we want to know the effective annual rate. Okay, effective annual rate we want to know. Now bond equivalent is yield was on a simple interest basis. This was on a simple interest basis. We want to know for a compounding basis now. So for compounding basis, we are going to see that's what is the yield per quarter, because it's a 3 months tenure. So the yield per quarter is going to be 1 lakh minus 97,550 divided by 97,550. 1 lakh minus 97,550. Okay. And this is divided by 97,550, which is 2.5115%. So yield per quarter is 2.5115%. So if I want a effective rate of interest per annum, that's going to be like 1 plus 2.5115%. The whole raised to 4 minus 1. So it's like 1 plus the rate of interest for the quarter raised to 4 quarters and then subtract 1. So this is going to be equal to which is 10.44%. Okay, so that's 10.44%, guys. Clear? Then third one, based on effective interest rate, the total annual cost of funds to the company shall approximately be. Okay, based on effective interest rate, the total annual cost of funds to the company shall approximately be. Annual cost of funds. So when we say based on the effective interest rate, You want to know I know the total annual cost of funds. So we have like not only the interest charges being paid, we are also going to pay brokerage for the for the quarter, plus rating charges is on an annual basis, plus the stamp duty for 3 months. So based on effective interest rate, total annual cost of funds will comprise of effective interest rate plus annual brokerage plus annual rating charge plus annual stamp duty. So effective interest rate, it was 10.44%, plus the annual brokerage is going to be 0.15%. This is 0.15%. So we need to make it into 4 because that's per quarter. Plus the annual rating charge is 0.5%, and annual stamp duty is 0.175%. 0.175% into 3. Sorry, into 4. Yeah. How much is this number, guys? How much is this number? Effective interest rate. What's this number? How much is this number, guys? Yeah, that's like what, 0.15 into 4, which is 0.6 plus 0.5, 1.1, then 0.175 into 4 plus 1.1 plus 10.44, which is 12.24. 12.24. So answer is option C. Okay. Now, fourth question now. Which of the following instruments cannot be used by a bank to meet its short-term funding requirements? So which of the following instruments cannot be used by a bank to meet its short-term funding requirement? Call or notice money, commercial paper, certificate of deposit, or repurchase agreement. Yep. So which of the following instrument cannot be used by bank, guys? What's the answer for this? Do you think? Which of the following instruments cannot be used by bank to meet its short-term funding requirement? Call or notice money, commercial paper, certificate of deposit, or repurchase agreement. Which of these instruments is not used by bank? Call or notice money is used by bank. Commercial paper is not used by bank, guys, because these are issued. I mean, the commercial papers are issued by the corporates. Commercial papers are issued by highly rated corporate entities to meet their short-term funding requirement. Okay. The short-term funding requirement, we can say commercial paper uh, is something which is not applicable to the banks because that's used by the companies. Then, fifth one, the period of commercial paper ranges from 14 to 364 days, 3 months to 6 months, 7 days to 1 year, or from 1 year to 3 years. The commercial papers are issued by the companies, highly rated corporate entities, uh, which range from 7 days to 1 year. So these range from 7 days to 1 year. You may issue a 7 day commercial paper, or a 14 day, or a 50 day, or a 90 day. But maximum that you can have is up to a 1 year tenure of commercial paper. This is a commercial paper like similar to the treasury bills of government. Okay. So that brings this case scenario 3 to an end. Now let's go for case scenario 4. Now I just want you guys to solve this case scenario quickly, right, on your own. Right. So I'll just give you maybe around read this case scenario and to try to solve within next probably how many questions do we have? 5. Yeah. So 10 minutes. Yeah. Try to solve it and then I'll come with the solution for this. Try to solve this initially, guys. Come on. Fourth case scenario. Try to solve it. We've got 5 more minutes, guys. Are you able to get the answers? There's just a couple of minutes left, guys. Couple of minutes, and then we'll start the discussion. Okay, then let's start with the discussion, guys. So Here we have Mr. X on 1st July 2021. During the initial offer of some mutual fund invested 10,000 units having a face value of 10. So the total amount of investment will be, of course, 1 lakh. So on 31st March 2022, the dividend paid by mutual fund was 10%. At that time, Mr. X found that his annualized yield is 153.33%. Then on 31st December 2023, 20% dividend was given. On 31st March 2024, Mr. X redeemed all his balance of 11,296.11 units when his annualized yield was 73.52%. From the information given above, choose the correct answer to the following questions. So Mr. X on 1st July, during the initial offer, it has purchased 10,000 units having a face value of 10. On 31st March, the dividend paid by mutual fund was 10%, and Mr. X found that his annualized yield was 153.33%. On 31st December 2023, 20% dividend was given. Right. And on 31st March 2024, redeemed all his balance of 11,296.11 units when his annualized yield was 73.52. Now we have to answer total of 5 questions. So we want NAV as on 31st March 2022, units as on that date, dividend as on 31st March 2023, NAV as on 23, and NAV as on the closing date. Okay. So let me just take this question to a separate sheet and solve it in a more systematic manner. Okay. So amount of investment on 1st July 2021 is going to be 10,000 units into 10. So this is going to be 1 lakh amount of investment. Then after a year, as on 31st March 20, dividend paid by mutual fund was 10%, and Mr. X found that his annualized yield was 153.33%. So on 31st March 2022, the dividend paid by mutual fund was 10%. Okay. And he found that annualized yield at that point of time was 153.33%. So dividend was 10%. So we can definitely say amount of dividend on 31st March 2022, it will be 10% of 1 lakh, which is 10,000. 10% of 1 lakh, which is 10,000. So amount of dividend as on 31st March 2022 is 10,000. Now, since we see that initially we have purchased 10,000 units, but we are redeeming a higher number of units. So it simply means that we have received dividend in the form of new units. So we're looking at units allotted units allotted as a dividend on 31st March 2022. This is going to be 10,000 divided by the NAV as on that date, but we don't know what's the NAV as on that date. So we don't know that NAV. The units allotted as dividend is X. So we are assuming X is NAV on 31st March 2022. Assuming X is NAV as on 31st March 2022. Okay. So this is the units allotted as dividend as on 31st March. Now, if I ask you what is the annualized yield? Annualized yield is what? 153.33%. Annualized yield is 153.33%, right? So we have the annualized yield as on 31st March 2022, which is given to us annualized yield as 153.33%. The annualized yield as on 31st March 2022 is 153.33%. Then this 153.33% can be calculated as the value which is closing value. Closing value is going to be what? 10,000 units. Original 10,000 units. Plus the dividend that we have received as 10,000 upon X. This entire thing multiplied by X, because that's the value of your investment as an end, minus initial value of 1 lakh upon 1 lakh into 100 into number of months that we're going to have is from 1st July. So April, May, June, 3 months are gone. So it's going to be into 12 by 9. So it's going to be 100, 1 lakh into 153.33%. Okay. So let's do one thing. We'll make it as 153.33 into 1 lakh divided by 100 into 12. This is going to be into 9, right? This is equal to 10,000 X plus 10,000 minus 1 lakh. One 153.33 into 1 lakh into 9 divided by 100 and further divided by 12, which is 114,998 is equal to 10,000 X minus 90,000. 114,998 plus 90,000 divided by 10. So NAV divided by 1,000 also is 20.4998. So we get the value of X as 20.4998. So if you look at the options, option B, So correct answer is going to be option B. NAV as on 31st March 2022 shall be 20.5. Okay, so this is going to be 20.5. So NAV as on 31st March 2022 shall be 20.5. Okay, total number of units as on 31st March 2022. Now we need the total number of units also. So total units as on 31st March 2022 is going to be, originally we had 10,000 units, plus we have 10,000 divided by X. So which is 10,000 plus 10,000 divided by 20.4998. So this is going to be 10,000 divided by 20.4998, which is 487 plus 10,000, which is 10,488. So 10,488. That's the total number of units. Yeah. So option A is the correct one. Then we have to look at what's the dividend on the next date, right? So here we have on 31st December 2023, 20% dividend was given. Then on 31st March 2024, Mr. X redeemed all his balance 11,296 units when his annualized yield was 73.52. Okay, so on 31st December, 20% dividend was given. So what is the dividend given on 31st December, guys? Dividend earned on 31st December 2023. Dividend earned on 31st December 2023 is 20%. So it's going to be 20% of 10,488 into 10. So this is going to be 10,488 into 10 into 20%, which is 20,976. This is 20,976. So it's 20% of 10,488 into 10, which is 20,976. So that's the amount of dividend earned. So 20,975.6. It's approximately the same thing. Now, fourth one, NAV as on 31st March 2023 shall be approximately. Now, what will be the NAV as on 31st March 2023 now? Now, for NAV as on that date, we need to look at the number of units that we had. Right, so as on 31st March 2023, we don't know the NAV. Right, so we need to calculate that NAV. So let us say NAV as on 31st March 2023 be X. So we'll say let NAV as on 31st March 2023 be X, right? So NAV as on 31st March 2023 be X. So we can definitely say, therefore, units received as dividend. The units that we are receiving as dividend will be 20,976 divided by X. Right, so 20,976 divided by X. And the closing number of units that we have, total units on 31st March 2024 is going to be the original 10,488 units plus this 20,976 by X. And we know that the total of all those units are 11,296.11. So you can solve this and get the value of X. You can solve this and get the value of X. Right? So what's the value of X, guys? That should be 11,296.11. 11,296.11 minus 10,488, right? 808.11. So since this is 808.11, I need to divide 20,976 by 808.11, which is 25.95. So if you look at this, that's 25.95, option C, guys. 25.95, which is option C. Then NAV as on 31st March 2024 shall be approximately. Now, NAV as on that date, we need to look at. Now, here we say that when you sold this 11,296.11 units, when its annualized yield was 73.52. So 11,296.11 units, when an annualized yield was 73.52. So with this annualized yield of 73.52, I need to simply look at what's the closing value and what's the investment. So total units, we sold it and we got the NAV as 25.95 as the answer for 31st March 2023 NAV. Now we have to look at the next part, which is NAV as on 31st March 2024. Now we don't know what's the NAV as on that date. So we will simply say, let NAV on 31st March 2024 be X. So value of investment on 31st March 2024 will be 11,296.11 X. That's the NAV as on ending date. Minus you made an investment of 1 lakh. This divided by 1 lakh into 100 into what is the number of months? So we started the investment on 1st July 2021. Okay. So from 1st July till 31st March 2024, we can say that's accumulates to how many months, guys? 36 and minus 3, 33 months. Right. So that's going to be into 33 months, if it's going to be 33 months into 12 by 33, right? So what is the NAV that we're getting? Because this is supposed to be equal to how much? Annualized yield was 73.52. Okay, so into 73 so that should be equal to 73.52. So 11,296.11x minus 1 lakh upon 1 lakh into 100 into 12 by 33. That's equal to 73.52. So can I just solve x over here? Get the value of x, guys. What's the value of x? Solve this and get the value of x. What is the value of x, guys? Solve it. I'm giving the value of x over here. What's the value of x we're getting is 11,296.11. Okay, so that's need to get it as 11,296.11x minus 1 lakh is equal to 73.52 into 1 lakh into 33 divided by 100 into 12. 73.52 into 1 lakh into 33 divided by 100 divided by 12 minus, no, only minus, it should be plus 1 lakh divided by 11,296.11. That's 26.75. Do we have it in the option? 26.75. Yes, option C. That's 26.75. That's the value of, I mean, that's the NAV as on 31st March. Okay, please explain 12 by 33. This is the return that you have. This is the return that you have on a 33 months. So this 33 months range from 1st July 2020, 1st July 2022 it was, right? Yeah, 1st July 2021, sorry. 1st July 2021 to 31st March 2024. So that is your 33 months. So this time schedule is for 33 months. This is the time schedule for 33 months. And the numerator 12. Numerator 12 is for annualizing it. Okay. Is it clear, Khalid? Is it clear, Khalid? Yeah. Okay. So that brings this case study 4 to an end. Now let's just take a break, right? So let's take a break of around 15 minutes, and then we'll join back for discussing the next case. And after that, we'll revise few concepts also. Okay. So let's just take a break, guys. Right, guys. Shall we begin? Are we there, everyone? Okay, so let us continue. Yeah. So case scenario 5. You are an investment analyst working for a financial advisory firm. You have been asked to analyze the bond market's yield curve to assist your clients in making investment decision. The yield curve represents the relationship between the interest rate yield and the time to maturity for the debt securities, usually the government bonds. So as an investment analyst working for a financial advisory, you have to analyze the bond market's yield curve, which will help to assist our client in making investment decision. The yield curve is given. Okay. So assume the following data yield for government bond over various maturities. So here 1, 2, 3, 5, 7, 9. So we have this yield rates which are applicable, which are ongoing market. From the following information, choose the correct answer to the following questions. Okay. So here we have one second. Yeah. So 1 year yield is 3%, 2 year yield is 4%, 3 year yield is 5%, 5 year yield is 6.47, 7.4, and 7.6%. These are the yield given for the respective tenures. From the information given above, choose the correct answer to the following questions. You have to choose the correct answer to the following questions. The main characteristic of normal yield curve is. The main characteristic of the normal yield curve is. What do we see over here in this yield curve? What's the characteristic? Short-term yields are higher than the long-term yield? No, doesn't seem. Second option, short-term yields are lower than the long-term yields? Seems to be, right? Short-term yields are lower than the long-term yield. Yes, definitely. This is what we can observe. And then the yield remains same across all maturities. No. Yields fluctuate randomly over different maturities. No. So obviously the correct one is option B. Based on the revised yield data, what is the yield spread between 10-year bond and 1-year bond? Yield spread. Yield spread is basically difference in the yield. So yield spread is going to be 10-year yield minus 1-year yield. So 10-year yield is 7% minus 1-year yield is 3%, which is 4%. So option C is the accurate one. An inverted yield curve typically indicates. What does that, inverted yield curve typically indicate? An inverted yield curve. So when you say inverted yield curve means short-term yields are higher than long-term yields. So shorter tenure bonds are higher than the long-term yields. Now, what does this situation typically indicate? Does it indicate economic growth, economic uncertainty, upcoming recession, or inflationary pressure? Then, of course, here we can see it's a case of upcoming recession. Because when you say that short-term yields are high, people are ready to invest right now because they are putting more money into the savings because they are observing that in next few months or days, they are going to face the recession. So to ride over that recession, people would like to, investors would like to take a safe position by investing in short-term bonds. So therefore, option C is the accurate one. Then an investor is looking to invest for 2 years, starting 3 years from now. The forward rate he would expect shall be. So if an investor is looking to invest 2 years, starting 3 years from now, to invest for 2 years, starting 3 years from now. So for 2 years, after 3 years. So basically we have year 0, 1, so we want to invest for 2 years, 3 years from now. So we want to know this rate. We want to know this rate. Okay, for this rate, for calculating this rate, do we have the 5-year yield? Yes, 5-year yield is 6%. So this entire yield is 6%, and the 3-year yield is 5%. So we want to know this particular yield percentage. So how do we calculate this one, guys? Can you calculate and tell me the answer? Can you just calculate and tell me the answer, guys? Just calculate and give me the answer, guys. Well, you should be looking at simply, it should be, this can actually be solved as 1.05 raised to 3 into 1 plus some rate raised to 2 is equal to 1.06 raised to 5. Okay. This is what we are getting. So just try to get the value of R, guys, from this. Get the value of R from this. What is the value of R from this? Can we get it? So we can solve it as 1 plus R square is 1.06 raised to 5 upon 1.05 raised to 3. 1.06 1.06 raised to 5, 1.06, so into square cube raised to 4 raised to 5. So that's 1.3382 divided by 1.05. 1.05, which is 1.1576. So if I divide it, 1.3382 divided by 1.1576. Right. And so we have this as what? 1.1560. This will be raised to 1 by 2. Right. So this is going to be square root. And then minus 1. So we get R as 7.52%. So in the option, it is going to be option B. Then if an investor is looking to invest for 2 years, starting 5 years from now, forward rate he would be expecting shall be. Just calculate the forward rate for this. Try to answer this question 5 ways. It's on the similar lines as question 4. Try to answer question number 5. बाबा काम में बोले थे logic behind -1 because it's 1 plus r, right? So 1 comes on the other side for -1. If an investor is looking to invest for 2 years, starting 5 years from now, the forward rate he would expect shall be. So we need a 2-year and 5-year thing. So let me just erase this. So we have like 0 to 2. No, we want to invest for 2 years starting from 5 years from now. So 5 and 7. So we want to invest for 2 years starting from 5 years from now. So we know the rate of 7 years and we know the rate of 5 years. So for 7 years, we have the rate as 6.4%. And for 5 years, we have the rate as 6%. Okay. So 6.4% and 6%. You want to know the rate between 5 and 7 years. So essentially this 1.064 raised to 7 will be equal to 1.06 raised to 5 into 1 plus r raised to 2. One 1.064 raised to 7. So 2, 3, 4, 5, 6, 7. 1.5438 upon 1.06 raised to 5, 2, 3, 4, 5, which is 1.3382 is 1 plus r the whole square. So 1.5438 divided by 1.3382, right? So this is 1.1536 is 1 plus r the whole square. 1.1536 square root. So that's like 7.4%. So R is 7.41%. So option A is correct one. Okay, fine. Okay, so that brings an end to this case study. Now let me just take this remaining time as an opportunity to discuss about the concept of modified duration. We will revise the concept of modified durations, Macaulay duration, and Also, if possible, we'll also discuss something about bond immunization. Okay. Do we remember what is a Macaulay duration and modified duration? Do you remember what is Macaulay duration and modified duration? Yes or no, guys? What's the Macaulay duration and modified duration? Yep. What was Macaulay duration and modified duration? Do you remember? Macaulay duration was the weighted average. Macaulay duration was the weighted average time period of investment. So Macaulay duration is the weighted average time period of investment. Macaulay duration is the weighted average time period of investment. So, for example, let us consider a bond with face value of 1000. Okay. Face value of bond, which is 1000. Let's say term of the bond is 7 years. Term of the bond is 7 years. Coupon rate is 7%. And suppose the YTM is 8%. And redemption value is, let's say, 1050. The redemption value is 1050. So the face value of the bond is 1000, term is 7 years, coupon is 7%, YTM is 8%, and redemption value of the bond is 1050. Okay. So now we want to know what's going to be the Macaulay duration. Macaulay duration, as I said, is just a weighted average time period of investment, right? So how do we calculate this Macaulay duration? We write down year, cash flows, take down the PV factors, and then get the PV. So year 1, 2, 3, 4, 5, 6, 7. The cash flows that we have is every year it is 70. And then in the 7th year, it's going to be 1050 plus 70, which is 1120. So 70 plus 1050 plus the last coupon of 70. Yeah, that is 1120. Now take the PV factor at 8% and calculate the PV values first. Get the PV values first because we want to take the weighted average. So we know weighted average is simply summation of weights, summation of time period into PV upon summation of PV. So years it is T. Right? Just take the total of present values, guys. In fact, write down all the present values and give me the total because then I'll have to have another column as PV into T. And then we need to take a total. Provide me the total of both these columns quickly, guys. Okay, so let's write down the PV factors. 1 divided by 1.08, which is 0.9259. Further, it is 0.8574. 0.7938, 0.7350, 0.6806, then it is 0.6302, 0.5835. So these are the PV factors. So let's write down the PVs. 70 into 0.9259, which is 64.81. Then it is 70 into 0.8574, which is 60.02. 7 to 0.7938, 55.57, 70 into 0.7350, 51.45, then 0.6806 into 70, which is 47.64, 70 into 0.6302, which is 44.11. Then it is 1120 into 0.5835, which is 653.52. So what's the total of PVs, guys? Total of all PVs, 64.81 plus 60.02 plus 55.57 plus 51.45 plus 47.64 plus 44.11 plus 653.52. So this is 977.12. Okay. Then what is PV into T? So that's 64.81. Then it's 60.02 into 2, which is 120.04. 55.57 into 3, which is 166.71. 51.45 into 4, which is 205.8. 47.64 into 5, which is 238.2. And then 44.11 into 6, 264.66. Okay. And then 653.52 into 7, 4574.64. Okay, so what's the total of this PV into T? Total of PV into T, 64.81 plus 120.04 plus 166.71 plus 205.8 plus 238.2 plus 264.66 plus 4574.64, which is 5634.86. So what will be the Macaulay duration? Macaulay duration is 5634.86 divided by 977.12. So this divided by 977.12, which is 5.77 years. And what is the modified duration? Modified duration is Macaulay duration upon 1 plus yield. So Macaulay duration is 5.77 upon 1 plus yield will be 1.08. 5.77 divided by 1.08. So that's 5.34. Right, so 5.34 times. That's your modified duration. So how do we interpret this modified duration of 5.34? How do we interpret this modified duration of 5.34 ways? 5.34 modified duration means that that for 1%, for 1% change in yield, for 1% change in yield, there will be 5.34% change in bond value. There will be 5.34% change in the bond value. Correct, guys? Do we remember this? Yeah. So that's our Macaulay duration, modified duration calculation. Now, we will try to understand that there is some concept called as bond immunization. So bond immunization is essentially, it's a technique or it's a method by which method to match. It's a method to match Macaulay duration of bond portfolio. It's a method to match Macaulay duration of bond portfolio to. It's a method to match Macaulay duration of bond portfolio to required maturity. Right. So basically, we invest in a portfolio of bond whose Macaulay duration is equal to maturity. Okay, so let's say this was a bond with a modified duration, sorry, with a Macaulay duration of 5.77. Okay, and let's say our required maturity so our required maturity is suppose let's say 3 years. Okay, so we are going to, our required maturity is let's say 3 years. So we will invest in 2 bonds whose portfolio Macaulay duration is equal to 3 years. Now we already have a bond with a Macaulay duration of 5.77 years. We already have a bond with a Macaulay duration of 5.77 years. Now let's say I give you another bond. So let's say this was our bond X, right? And we have, let's say, bond Y, whose term is 3 years. Okay. Face value is 1000. YTM is 10%. Sorry, YTM was what? 8%. Coupon is 6%. And redemption value is 1000. The term is 3 years, face value 1000, YTM is 8%, coupon is 6%, redemption value is 1000. So first you give me for this bond, what is the Macaulay duration, guys? Can you calculate the Macaulay duration for this bond? Yep. Can we calculate the Macaulay duration for this bond? Try to calculate the Macaulay duration, guys. We get it as what? We write down the years, cash flow, PV factor at the rate of 8%, PV into time period. So it is like here 1, 2, 3. Give me this total and calculate the Macaulay duration first quickly. Calculate the Macaulay duration quickly. Okay. So the PV is what? 948. PV is 948. The cash flows are like 60, 60, and 1060. Yes. So present value factor at 8%. One divided by 1.08. This is 0.9259. Then it is 0.8573. Then it is 0.7938. So PV is going to be 60 into 0.9259, 55.55, 0.8573 into 60.7938. 55.55 plus 51.44 plus 841.43, which is 948.42. Okay. So PV into 2 is 2682.71. Okay. Yes. So now the Macaulay duration over here will be 2682.71. 2682.71 divided by 948.42. So how much is this Macaulay duration? That is 2.8286 years. Okay. And if I ask you what is the modified duration, this will be 2.8286 divided by 1.08, right? Modified duration is 2.6191. Okay. Now, coming back to our bond immunization strategy, we want to invest in a bond. We want to invest in a bond whose Macaulay duration, or a portfolio of bond whose Macaulay duration is going to be equal to the maturity. Okay. Okay. So now we'll say let W be the weightage of bond X. Let W be the weightage of bond X. So it's going to be W into the weightage is what? I mean, the Macaulay duration is 5.77, right? So it's going to be 5.77 weightage is plus 2.8286. 2.8286 1 minus weightage is equal to 5.77 W plus 2.8286 into 1 minus W is equal to the target duration was over here 3. So can you just tell me what should be the weightage over here? What should the weightage that I should be weightage of money that I should be investing in bond X? Get me the weightage value, guys. What is the weightage? 5.77 W plus 2.8286 minus 2.8286 W is 3. So 5.77 minus 0.8286, 2.9414 W plus 2.8286 is equal to 3. Right? So here we have the weightage as 3 minus 2.8286. So W will be this divided by 2.9414. 0.05 0.05827. W is 0.0583. That's the weightage in bond X. So what will be weightage in bond Y? It is simply minus 1. 0.0583 minus 1, which is 0.9417. Got it? This is the amount of investment that we're making in the bond Y. Right? So whatever is the amount of investment in present value terms you're making, that should be done. Okay. $0.9417, that's the weightage in bond Y. Now, when you're doing this sort of investment, this ensures that when you're investing in this proportion, that is going to help you investing in this proportion. This will help you to match your bond portfolio. Bond portfolio is going to be immunized against any increase or decrease in the bond value. It's not going to get affected by any increase or decrease in the bond value, guys. Okay. Now, let me just take a moment to we've done this bond immunization revision. Okay, then let me come back to the mutual fund performance evaluation concepts, right? Because bond evaluation is done. Just wait. I'll recap one more concept from not from mutual fund. That's because very easy part. Let me just take up the dividend discount model. Okay. So we'll say equity valuation. Equity valuation. We'll look at the dividend discount model. Now let us say we have years and the growth rate. So year 1 to 5, you will have a growth rate of, let's say, 10%. And then year 5 onwards, and then from year 5 onwards, we are going to have 5% growth rate. Okay. The last dividend that we have paid was 10 rupee. K is 12%. Okay. Can you calculate the value of this bond? Can we, no, not the bond. Can you calculate the value of this equity share, guys? It's a two-stage dividend discount model. So what we will need is, we need to first calculate the dividends, which are obviously going to be represented by the cash flows. So year 1, 2, 3, 4, 5, cash flows are going to be like initially 10 into 1.1, which is 11. 11 into 1.05, which is 11.55. 11.55, sorry, not into 1.1 again. 11 into 1.1, which is 12.1. The next is going to be 12.1 into 1.1, which is 13.31. 13.31 into 1.1, which is 14.64. 14.64 into 1.1, 16.104. That's your cash flows. Now, I want the value of this share. So what I need, I just can't be taking the present value of these cash flows. Rather, what we need to do is, also in fifth year, I need to take the value. So from this, we can say, what is the value of dividend in year 6? Value of dividend in year 6. What is the amount of dividend in year 6, guys? Tell me. What is the amount of dividend in year 6? Yes, dividend in year 6 will be 16.104 into 1.05, right? 16.104 into 1.05, which is 16.91. Okay, so that's 16.91. But why do we need this dividend 6? Because I need to calculate the value of the share in years 5. So value of the share or the price of the share in year 5 is going to be D6 upon K minus G. D6 upon K minus G. So D6 is what? 16.91 upon K is 12%, so 0.12 minus the growth rate is 0.05. 16.91 upon 0.12 minus 0.05. Okay. So 16.91 divided by 0.07, which is 241.57. So this is the value of the share, which is 241.57. Okay, so 241.57, that's the value of the share in year 5. Now, take the PV factor at the rate of 12% and discount it. So 1 divided by 1.12, that's 0.8928. Further 0.7972, 0.7118, 0.6355, and 0.5674. So it's going to be 11 into 0.8928, which is 9.8208. Then 12.1 into 0.7972. 12.1 into 0.7972, which is 9.6461. 0.7118 into 13.31. That's 9.4741. 14.64 into 0.6355, which is 9.3037. 16.104 into 0.5674. 9.1374. 241.57 into 0.5674. 137.0668. Okay, so just take a total, which will give us the value of the share to us using two-stage dividend discounting. So 9.8208 plus 9.6461 plus 9.4741 plus 9.3037 plus 9.1374 plus 137.0668. That's 184. I did my doubt. Oh, I missed out on that. 9.8208 plus 9.6461 plus 9.4741 plus 9.3037 plus 9.1374 plus 137.0668. Oh, 1 second, there's an issue. 9.82, 9.64, 9 plus, okay, this one is a problem. 41 is not there. So 9.3037, 9.1374, 137.0668. 9.820, 9.6464, 9 point. Okay, one more is missing out over here. Plus 9.4741. Yeah, 184.45. So that's 184.45. Okay, have you done, everyone? So present value is 184.45. So remember, it's a two-stage dividend discount model, which is witnessing a high growth rate during the initial phase, and then it stabilizes to a lower growth rate later on, right? So this is what a typical dividend discount model or two-stage dividend discount model looks like. Now, remember that apart from these equity valuation technique, we do have some other techniques also, like, we use FCFF and FCFE method also. Right? FCFE, it is profit after tax. You add back the depreciation to that. Right? So PAT, add back the depreciation to that, plus any non-cash charges, right? So that FCFF, FCFE technique is also used. More often, we have also been witnessing increased usage of something called as EVA, which is the economic value added. Economic value added is computed as, net operating profit after tax minus weighted average cost of capital into total capital employed. And this NOPAT is nothing but EBIT into 1 minus T, EBIT into 1 minus T minus KO into total capital employed, right? So for example, if I tell you, let's say PAT is 500, tax rate is 30%, amount of interest is 50, total capital employed is 3,000, KO is 15%. Okay, KO is 15%. So can you calculate the EVA over here? Calculate the economic value added in this case is. Can you calculate the economic value added? Just calculate the economic value added here. Economic value added. Are we able to calculate it? See, first up, we need to get the EBIT. So since we have the profit after tax as 500, to that we will add, we can make this PBT easily. Profit before taxes, PAT upon 1 minus T, which is 500 upon 1 minus 0.3. So 500 divided by 0.7 is 714.29. Okay, 500 divided by 0.7, 714.29. This is our PBT. Add interest of 50, which will make it a EBIT of 764.29. Okay. And since we have the EBIT of 764.29, now we can actually calculate the economic value added as 764.29, which is our EBIT, into 1 minus 0.3 minus 3000 into 0.15. 764.29 into 0.7, that's 535 minus 3000 into 0.15, 450. So this is your 85. The economic value added is 85. Okay. So we have tried to revise in our today's session almost most of the topics, right? And we have also done few of the case studies, case and summary questions. So if you have any queries, we can just take it up right now, or we can call it a day one. Any queries, guys? Any queries from your end, guys?
Sir,
Yeah. Yeah, please go ahead. Hello. Someone was asking some query, I suppose.
जगबंधु जी आपका हो गया सेशन?
Yes, yes. हो गया सर. हाँ सर, हो गया.
आपका हो गया सेशन?
जी जी जी.
Okay, student. Thank you very much for this
continue.
This session.
So you continue.
So thanks for attending the session, and Jagbandu sir has taken the. We have taken the basically we have taken the case scenarios because I think from this case scenarios the conceptual understanding must be very strong. Those who have already taken the classes. Now these are today we have covered the chapter number 5 and 8. Both of MCQs we have covered, case scenario based MCQs. So student, if you have any query, you can send us through the email as well as you can contact us. Jagmandu sir, just share our phone number as well as email ID. 3045 956. And our email ID is asfm final @ICAI.in. Okay, student, thank you very much and for patient listening and prepare whatever has been discussed in today's class. See you in the next revisionary session. So please get updation from our schedule web hosted and on a day-to-day basis. Or even we have uploaded a schedule, but see, because we will upload also assignment, upload the assignment before the session, your sessions. Thank you very much. Have a nice day. Yes. Yes. Okay.
Okay. Bye-bye.